Hope you're all doing good. In today's session, we'll be taking up one particular concept which was tested in RTP November 2021. They asked the first question in RTP 2021 relating to a particular concept in joint operations. First, let's understand the concept, then let's solve this particular question. Okay. So now the theory aspect of that, it's there in our study material. So I'll try to give you a gist of what is that we're going to be solving. All right. Let's say there is let's understand, whenever there is a joint operations, okay. First, we need to check whenever there is a JV, we need to check whether that particular venture is a joint venture or a joint operations. Yes. Whenever two persons are coming together and having a joint control over things and starting it together, the first aspect here is to check whether that particular arrangement is a joint venture or is it a joint operation. Because if it is a joint venture, we apply equity method, okay, like associate. If it is joint on operations, then we do proportionate consolidation. Yes, proportionate method. Meaning all the, if there are two persons, means both the persons will take their share of assets and liability, they will record it in their respective books. Okay. So now this particular question that we are about to solve is not pertaining to joint venture, it's pertaining to joint operation. Okay, but it's good to know the difference between the two. We have already discussed it. I'm just giving you a quick recap of things. Now, if you want to find out whether it is a JV or a joint operations, okay, first we need to find out whether normally in case of JV, a new entity will be established, a new corporate or entity will be formed, and then few persons will come together and form a new entity. So new entity will be there in case of a joint venture. In case of a joint operation, no new entity will be established. That is one way to find out. Another way is in joint venture, the joint venturers, the parties, will have a share in net assets. Meaning if two persons have come together and have started a venture, the persons who have come together, they'll have a share in the net assets of that new entity. Okay. That is another way. Like, let's say there is a new venture called A Limited was formed. Okay. X came in, Y came in. Okay. X has 50% control over this. Y also has 50% control over A Limited. Okay. Now, if it is, let's say A Limited has some assets, they have a PPE worth 10 lakh. Let's say they have some liabilities. Let's say a financial liability they have, let's say worth 7 lakh rupees. If it is a joint venture, what happens is, okay, X and Y, the persons, I'm just referring to X here for simplicity, X will have a right over net assets of the business. So what is the net asset of this A Limited now? 10 lakh is PP, financial liability is 7 lakh. So the net assets will be, if this venture is to close down, first you will sell the assets. Let's say the realizable value of that asset is 10 lakh itself. So you will sell the assets and recover 10 lakh. From that you will pay off liabilities worth 7 lakh. So what remains is 3 lakh. Over this 3 lakh, X and Y will have rights. That's what we mean by the venturers will have a right over net assets of a business. This is in case of a JV. If it is a joint venture, the venturers will have a right over net assets. Suppose if it is a joint operations, then what will happen is X and Y, right? X and Y will have a proportionate right. Out of this 10 lakh, X will have 50% share over this assets. Okay. Similarly, out of this liability, X has to settle 50%, which is 3.5 lakh. Over each assets and liability, they'll have a respective share. Okay. So if company shuts down, then X will claim 50% of this asset. At the same time, he also needs to take responsibility for 50% of liability settlement also. This is the difference. Same goes for Y also. He'll also have a right over this assets and liability to the extent of 5 lakh, 3.5 lakh, like that, 50%. That is your joint operation. That's what we mean by proportionate, method of consolidation. Fine enough. So the question we are about to solve is pertaining to joint operations. So I've given you an idea as to how to identify now, right? Check whether a new entity is formed. If new entity is formed, it becomes a joint venture. And in case of a joint venture, the venturers will have right over net assets of a business. They'll not have a right over individual assets and liability. They'll have a right over net assets. But in case of joint operation, no new entity will be formed and each venturers will have a right over their respective assets and liabilities of the venture. That's the distinction. Okay. So that is the basic background to categories. Now, this is the first point that gets tested in that RTP question. Second one, let's take a further example. Same, let's say A Limited. Okay, one new venture is formed. Let's say there are three parties, X, Y, and Z. Let's say X has 60% right over this A Limited. Y has 30% right over this venture A Limited. Z has about 10% right in this A Limited. It's a joint operation. Okay, because no new entity, or let's say they started. If you think about new entity, then you will get confused. So just let's say they started just a joint operation, JO. Okay, fine. So X and YZ, they're sharing, or they have a right over this joint operation in this ratio, 60, 30, 10. The MTP uses the same percentage, RTP, so I've stuck to the same percentage. The concept here is, if any particular venturer, let's say Z told, I don't want to be part of this operation, but I have a right of 10% over it, right? So let's say Z sold his percentage, he sold his stake, that is 10%, let's say to Y Limited. In that case, how will you account? That is the crux of the RTP question. Is it okay? I'll repeat that. If any of the venturers sells his or her stake, okay, if he sells off, if that particular stake is sold to another venturer, then how should Y Limited, meaning the other venturer who has purchased, how should he record this transaction? Will you treat this as an asset acquisition, or will you treat this as a business acquisition? That is all is the funda of this particular concept. Okay, if one venturer has sold his stake to another venturer, the venturer who has purchased it, will he treat that acquisition as an asset acquisition or a business acquisition? That's all is the funda. Okay. Now, to answer this question, they have clearly given, if you just check your study material and consolidation, they have given certain pointers. This is what I've just called out. So I'm giving you a crux of that. What the standard says is, before you determine whether this is asset or business acquisition, first find out whether this joint operation that you're doing, is it a business? First ask this question. The joint operation that you're doing, first check whether it meets the definition of a business. Business means what? There should be inputs and there must be substantive process which are capable of generating output. It's not necessary output should be there. If you have input and substantive process which have the capability of generating outputs, then it will be treated as a business. Is it okay? So first check whether this joint operation is a business. If you conclude, yes, this joint operation is a business, then Y Limited or Y has purchased a stake from Z Limited, then the stake purchased, okay, the interest purchase we'll call it, the interest purchased by, here it is Y Limited, right, will be considered as a business acquisition, and Ind AS 103 ka funda, Ind AS 103 deals with business combination, right? So Ind AS 103 ka principles will apply, or Ind AS 3 applies. That is all this particular concept is all about. First check whether this joint operation is a business. Business means there has to be an input like your assets, human resource, etc. Process, okay? If you check whether we have a substantive process built in, if input and process is there which have the capability to generate output, or if already output is there, doesn't matter, okay, then it becomes a business. If that joint operation is a business, then the stake that one venturer has purchased from the other, here Y has purchased from Z, right, that particular interest purchased will be treated as business acquisition and not asset acquisition. Since it is a business acquisition, Ind AS 103 ka provisions will apply. So what and all you need to do in Ind AS 103? All the net assets, you have to record it at fair value, 1. You need to find out goodwill or bargain purchase gain, BPG, alright. Then, since all the assets you are taking over at fair value, okay, there could be some DTA, DTL ka funda as well. So you need to recognize all of this. That's all is the crux of this particular concept which they've written it over here. They've written in big words, I've just given it off here. Okay, one more thing is, sir, what about the existing 30% Y Limited already has? The standard gives a guidance that the existing 30% which Y Limited already has need not be remeasured. This is not a step acquisition. Okay, you don't have to think earlier we had 10%, 30%, now we acquired another 10%, so we'll make it as a step acquisition. No. Standard clearly is giving us a guidance that the previously held interest need not be remeasured. You don't have to do anything about the previous. This 30% stake which Y Limited already has in Geo, that you don't have to do anything. No remeasurement for that is required. Only for this 10%, you apply business combination ka funda, recognize goodwill or bargain purchase gain and do it. Okay. So that's all as the next point. The existing interest of Y Limited, in my example 30%, need not be remeasured. Need not be remeasured. Should not be remeasured, in fact. Okay? Need not mean, should not be only, right? Should not, because the standard is saying you should not remeasure that. Should not be remeasured. So this is not a step acquisition. That's what I'm trying to say. Alright, this is the funda, sir. It's given in theory. I've just explained you in the form of an example. This particular funda got tested in our RTP. Earlier, the concept was there in study material, but there was no question backing that. But in RTP November 2021, they brought in a question relating to this concept. So let's have a quick recap again. If it is a joint operation, first determine whether it is a JV or joint operation. If it is a joint operations, okay, then check, okay, first whether that JV is a business. If you conclude that the joint operation is a business, then if one venturer has purchased a stake from the other, then that stake or interest purchased, since that JO is a business, the interest purchase also will be treated as a business acquisition, and Ind AS 103 ka all the fundas will get applicable there. Okay. Alright. So now that's what I've just given you theory also here. You don't have to worry. Same thing I've just given it over here. If you want to go through that, all the assets should be recorded at fair value. DTA, DTL you need to recognize goodwill or bargain purchase gain. Okay. Then on this goodwill or bargain purchase gain, you don't have to amortize. You test it for impairment. If there is any transaction cost associated with that, if there is any acquisition cost in business combination, any acquisition cost will be expensed off, meaning it will go off to P&L. That's all as a funda they've just called out over here. Okay. Alright, if the concept is clear, we can dive into this question. Actually, this is a big question. Alright, if you just counted a number of pages, normally that's what we do, no? First time when we see the question, we'll start counting the pages. How many question is there? How big is this? If you actually count this, no, it comes up to 8 or 9 pages. So majority of the students will think, yoppa, so big question, no, we'll not have time. Actually, this is the easiest question, just a hyped question. It may look a very lengthy question, but it is actually very, very straightforward. Hardly it takes 15-20 minutes to solve this. Okay, but just that they have tried to elaborate and make it projected big. So you will get it, what I'm trying to say. Let's go over and try to solve this question. So company X is engaged in the business of exploration and development of oil and gas blocks. So they are doing some exploration activity relating to oil exploration they're doing. Company X currently holds participating interest. They have some stake in producing block as follows. They have a participating interest in below mentioned producing block. This is the keyword. What do we mean by producing block? So you have a stake in, you have an interest in one operation. Okay. That operation is already, it's a producing block, means output is available. Because first thing you need to check whether that operation is a business. No? Okay. For that you need to have input, process and output. So it's not necessary output should be available. You should have the capability of generating output. But in this problem, since they're saying it's a producing block, output is already available. Okay. So looks like it is we are getting a feeler that it is a business, this operation. Okay. The block name they have given. So they've not formed a new entity. See, they've just formed a block. Okay. It's not a new entity. So all of them have come together and doing some operations. That's all. That operation ka name they are calling it as AWM/01. That's it. And X has about 30% interest, Y has 60 and Z has about 10. So totally 100% they have. For the above block, company X, Y and Z are entered into unincorporated joint venture. Sir, it's the moment they say it's unincorporated joint venture. Slowly we'll move on to which side of things. This is a joint operations. Yes. So we'll have to do a proportionate accounting, not equity method, because they said it's an unincorporated joint venture. So that means it's a JO, joint operation. Awesome. The company Y is the operator of the block. So he has taken the lead role. Okay. Company X and Z are the joint operators. Fair enough. So these guys are joint operators. Y incurs all the expenditure on behalf of joint venture and raises cash call to company X and Z. So first initially Y will make all the expenditure. Later he will ask Y, X and Z ka their respective share, Y will collect it from them. That's all they're doing. all the manpower and requisite facilities such as machineries owned by the joint venture and therefore owned by all the joint operators. So this is the keyword. Okay, all the manpower and these facilities are all inputs, right? Okay, required facilities also they are taking, machineries and all inputs owned by the joint venture and thereby owned by all the joint operators. So they're saying all the joint operators, that is X, Y, Z, they have a right over all the assets. Since they are saying all the joint operators have a right over the assets, they don't have a right over net assets, they have a right over the asset itself. That means this is again a point trying to prove that this is a joint operation, because in joint operations the guys will have the stake over assets and liability, proportionate share. That's what is happening over here. Alright, fair enough. For the past few months, due to liquidity issues, company Z defaulted in the payment of cash calls to operator. Z has not given his share of money to company Y. Alright, he has not paid out. Therefore, company Y has issued a notice to Z for withdrawal of participating interest. So Y is saying, I'll take off your interest. Z has filed appeal with arbitrator. So he went to arbitrator and said, hey boss, this is what is happening. Kindly help me out over here. Alright, final performance or financial performance of Z has not been improved in the subsequent months. Therefore, X has decided to withdraw participating interest. So X told, sorry, I don't want to be part of this operation. So indirectly they're telling, Z is selling his stake. Whatever stake he already has 10%, no? That probably he'll sell it off. We'll see to whom and all he has sold. So he is withdrawing participating interest from block and enter into a sale agreement with company X and company Y. So you want to sell it to both of them. As per the terms of the agreement, X will receive 33.33% share and Y will receive 66.66% share of participating rights owned by Z. So 1/3 of this Z ka 10%, right? 1/3. 33.33 is nothing but 1/3, no? 1/3 went to X, 2/3 went to Y. That's what they're saying it as 33.33% and all that. Okay. So 1/3 of his stake, X, he sold it to. 2/3 of his stake, he sold it off to Y. Company X is required to pay 1 lakh. If you just check, they are giving all the data about company X. So they're talking basically about the company X wala fund over here, because those two are the joint operators, right? Okay, company X is required to pay 1 lakh against this share, 33% share of participating interest, right, owned by Z. So obviously, he's purchasing some stake from Z means he has to pay money now. So this is your purchase consideration, PC. To get this 1/3 stake of Z, X is paying 1 lakh is what they're saying, purchase consideration. After signing of the agreement, operator Y approached the government of India for modification of production sharing contract, that is removal of company Z from this PSC AMW. Government has approved this transaction on 30th June. So basically, the stake sale agreement happened on 31st May. Okay, but the government gave the approval on 30th June. They're giving these 2 days to find out the date of, for you to account it as business acquisition, you need to know acquisition date, right? So here acquisition date will be 31st May or 30th June. See, normally, like what, the acquisition date is a date on which legally you are required to pay your PC, okay, which is 31st May. But here they're saying it's an exploration business. Normally for exploration business and all, you need to take license from the government. Okay, government will have certain conditions. They'll check certain conditions and then only give the permission. So if there is any change, government approval becomes a necessity. It is a must. Here it is not a formality. If government approval was a formality, you could have taken 31st May itself as an acquisition date. But in these cases, government approval is substantive. Okay, so that's what they've given it also. Check. Government approval for modification is essential given the industry in which this operate. That means it is a must. Without government approval, you cannot go ahead with this agreement. So this 30th June will be the acquisition date. So you need to do all your business combination activity on 30th June over here and not 31st May. Okay. In this particular problem. Hope you got it. Because the government approval is very much essential for you, for the agreement to go through. Okay. So then they have given company X ka balance sheet, company Z ka balance sheet. On 31st May, whatever data they have given is irrelevant because our acquisition date is 30th June. On 30th June, X ka balance sheet they have given, Z ka balance sheet they have given. This is fine. We'll see it later. Okay. Now, couple of things we can straight away answer. You need to determine the following. 1. Whether the above acquisition falls under business or asset acquisition as defined under business combination in days 103. Okay. In this you need to do all for X one thing. Okay. Whether this X has acquired some stake from Z over here. No? X has acquired some stake from Z. Whether this is an asset acquisition or business acquisition. That's what we learned now and came, right? Before you answer that question, check whether this joint operation is a business. Is it a business? Yes. It's a producing block. So output is there. Okay, you have inputs also. See, exploration activity means the process is obviously substantive. You need to have a process. Just like that, you can't explore any area, right? Yes. So there'll be a certain process and protocols you'll follow. Okay, certain documentations will be there. So process will be substantive. So inputs is there, process is there, output is already there. It was sufficient for us. If the capability of generating output was there, then only it would have been a business. But here, actual output itself is there. So obviously, the answer to the first question is yes. It is a business acquisition. It is a business acquisition by applying the Ind AS 103 ka funda. Okay, one is that. Second one, determine the acquisition date, which we already got it. That is 30th June 20x1. Which day was that? Yeah, 30th June 20x1, the date on which the government has approved, because government approval is absolutely necessary over here. Pass journal entries for the above mentioned transaction in the books of X, because Y ka data and all they have not given. X ka data only you need to do over here. And draft the balance sheet of X after as at the acquisition date. Redraft. Okay, after acquisition, you draft the balance sheet. Now, simple things. Simple business acquisition it has become. So, you need to put up the funda. So, if it's a business acquisition, you need to find out what, sir? Goodwill or bargain purchase gain, no? Okay, maybe I'll do it off, then we can check off this. Alright, maybe before that, I think they've given certain data as well. Let's read the data. They've given additional information. Let's go through that once. The fair value of PPE and development capital work in progress. See here, PPE and development capital work in progress of Z. Given value is 3 lakh. This is our carrying amount. Okay. And this is 1 lakh for development work in progress. They've also given the fair value. The fair value of this PPE is 5 lakh. Fair value of development capital work in progress is 2 lakh. Fair value of this is 5. Fair value of this is 2. Since we already determined that the stake purchased is a business acquisition, do you think in business acquisition, are we interested in the carrying amount or all the assets, is it reflected at fair value? All the assets in business combination will be shown by the acquirer at the fair value. So that means this is relevant to us. Got it? Okay. That means, sir, 3 lakh worth of asset, you showed it at 5 lakh. There is an increase, no? Yes. What is the increase, sir? 2 lakh, and here there is an increase of 3 lakh. Or 1 lakh. So total increase is 3 lakh. So there will be some deferred tax liability impact on this also. Yes or no? Because your revised carrying amount became 5 lakh. If you want to calculate here, tax base will be same only. Tax base is still 3 lakh and 1 lakh only. So there is a difference. This is 7 lakh. This is 4 lakh. So if carrying amount is greater than the tax base, we get taxable timing difference on which you need to create deferred tax liability. Yes. So here the carrying amount is greater than the tax base by 3 lakh. So whatever is the tax rate you need to find out. Here it is given. The tax rate is 30%. So to the extent of 30%, 3 lakh or 30% if you do, you're going to get 90,000 as the deferred tax liability ka impact because of this. Okay, because you need to take over all the assets at fair value. But will we take full sir? No. X will only getting 1/3 share. No. So all I've given it at full value. Then you need, for everything we need to multiply 1/3, 1/3, 1/3 and do it. Because X, they clearly told, no? X has acquired only 1/3 of the participating interest from Z. Okay. So this is a full value. This is for 100%. For 1/3, 1/3, we need to prorate everything. But I'll do it. Okay. We just reading it. The fair value of the other assets are assumed to be at carrying value. So other assets ka carrying amount itself is a fair value they're saying. Except cash and cash equivalents. Okay. Cash and cash equivalents of the companies that are not to be acquired. So cash, one asset, no. Z is saying I won't give you. Other assets and liabilities you can take over. So that we can cut off. Tax rate is 30%. Fair enough. As per Ind AS 28, all the joint operation, the sentence is little dicey. I don't know why they gave it. Because joint operation is not covered under Ind AS 28. It gets covered under Ind AS 11111. Okay. Fair enough. Just for the sake of it, I'll read it off. As per Ind AS 28, all the joint operators are joint venturers whereby each parties have a joint control of the arrangements to have right in the net assets. This is wrong again. Because if they have a share in the net assets, we can't do this accounting. We have to apply equity method wala accounting. Okay. At the same time, look at the next line. Therefore, every operator records their share of assets and liability. No. In case they have a right over net assets, then you'll have to apply equity method. In equity method, we have already done. We don't show assets and liabilities. We only show our investments. Yes, under equity method. So this sentence, I think there is a typo, which I think they'll correct it. Don't worry. Yeah, this is ignoring this. We'll ignore this for now and just go ahead with a calculation. Okay, because all the solution is based on this ignorance only. Okay, no worries. So that means now you know funda. Now simple what? You have acquired some stake that is a business. So you need to apply business combination ka standard. Find out goodwill or bargain purchase gain. That's all. So we'll put up one working note to find out goodwill or bargain purchase gain over here. Goodwill or BPG. All the assets you need to take over at fair value. So one by one, let's take off all the assets. First asset is what? PP. Now PP, will you take it at 3 lakh? No. We need to take fair value. Fair value of this PP, they have given it to be 5 lakh. But this is for 100%. This is the total assets of Z. X did not acquire 100% rights of Z. They acquired only 1/3, right? Because 2/3 went to Y. So for 1/3, how much is it? 5 lakh into 1/3 will be 1,66,667. Like this, all the assets one by one you jot down. Or if you want, you can just do it like this also. 1 minute. Maybe we'll present it in the actual format itself. To find out goodwill or bargain purchase gain, we need to consider a few things, right? One, we have PC. To get the stake, they told X paid 1 lakh rupees to Z. So PC paid is 1 lakh, that is straightforward. Okay. Then you need to compare PC with the net assets. Fair value of net assets, in fact. So we'll write fair value of net assets. So what about non-controlling interest? So there is no non-controlling interest concept over here, okay? Because it's 100% acquisition over there, okay? So you just compare PC with net assets. The differentiating figure is what they have recommended to be is goodwill or bargain purchase gain. Okay, you have to treat it like business combination. So accounting will run like that. There will not be any non-controlling interest in these sort of a joint operation ka stake sale. Done? Alright. Then PPA over, then right of use asset, ROU we have, which is 20,000. So again, all assets ka 1/3 you need to take. That will be 6,667. Then development CGIP, carrying amount is 1 lakh, but we are interested in fair value. I'm going the fair value to be 2 lakh. So let's take that. Development CWIP, capital work in progress, 3 lakh, right? No, actually 2 lakh. 2 lakh ka 1/3. So if you do 2 lakh into 1/3, you're going to get 66,667. And then loan receivable, it's a financial asset loan receivable, that is 50,000. 50,000 ka 1/3 you calculate. That will be 16,667. Next, it is inventory, 30,000 ka 1/3 you calculate. That will be 10,000. Your inventory. Next is your trade receivables. Okay, we'll write it as TR for short form. That is how much? Trade receivable is 1 lakh. Okay, 1 lakh into 1/3. That will be 33,333. Cash was not taken over, so it is fine. Other current assets was 50,000. Other current assets, 50,000 divided by 3 will give you 16,667. And then, okay, liabilities, equity share capital, other equity can't be taken over, only assets and liabilities. Provision 2 lakh, other liability 1 lakh. Provision 2 lakh, other current liability 1 lakh. But we also have a deferred tax liability over here. Yes, if you want, you can put up a separate working note for that as well. Okay, DTL we already calculated over here, right? So right now I'm showing you. If you want, you can show DTL as a separate working note. Total DTL is 90,000. Or if you want, you can show it like this only. The fair value change is how much? Fair value increase for this is the difference here is 2 lakh. Here the difference is 1 lakh. So that means you will write here the fair value difference is 3 lakh totally. Okay, this is your taxable timing difference. Of this into 30% you have to do because you have to create DTL for that. And in that X ka stake is 1/3. So 3 lakh into 30% is 90. 90 divided by 3 is 30,000. So 30,000 will be the DTL. So here it will be 2 lakh into 1/3. Here it will be 1 lakh into 1/3. So this will be how much? 66,667. All the liabilities we will reduce. And this will be 33,333. This also will reduce. So if you do this, you're going to get the fair value of net assets. So that will be how much? 16,667 plus 6667 plus 6667 plus 16667 plus 10,000 plus 33,333 plus 16,667 minus 60. Okay, minus 3333 minus 30,000. If you do, my calculator is showing 1,86,668. I got the value right? Or did I do any calculation mistake there? One check. Just quickly check off also. Same numbers. No, they got 90. How? Same value. Just let's quickly just check off maybe. Did I do any calculation mistake? 1 minute. Let me just check off. Do we have other assets? Oh, actually, trade payable is also there. Trade payable is 2 lakh. One more asset is there. Okay. I think I'll have to bring this down then. One more asset is there. Trade payable. Trade payable, they've given it to be on 30th June. It is 2 lakh. Okay. So 2 lakh ka 1 by 3 if you do. That will be 66,667. If I do this, 186,668. Minus getting 1,20,000. Yeah. So I'm getting 1,20,000 1 rupee. So I'm just rounding it off to 1,20,000. So that is your fair value of net assets after doing everything. So PC is 1 lakh. Okay. Fair value of net assets is 1,20,000. That means it is a case of goodwill or bargain purchase gain. It is a bargain purchase gain. Yes. Asset ka worth is 120, but you paid only 1 lakh. So 20,000 is bargain purchase gain. Capital reserve basically. That is what they've done here. The same thing, they've asked the journal entry, sir. In journal entry, what do? All the assets you will debit. All these liability you will credit. PC paid 1 lakh rupees. PC paid 1 lakh rupees you will credit. You will credit bargain purchase gain of 20,000. That is what they've done over here. Check. All the assets debit. All the liability including DTL credit. PC paid credit. Bargain purchase gain 20,000 credit. That's all. That is the third requirement of this problem. Is there any difficulty? No. Yes, pretty easy stuff. Yes. Fourth one is the redraft the balance sheet. After acquisition, show the balance sheet. This is child's play, no? Okay, on 30th June, X ka balance sheet they have given. Okay. Now X has acquired some assets and liabilities from Z. Go on adding all these assets, no? You need to go on adding. That's it. This you need to keep adding to the assets. That's what they've done in the next thing. Existing assets of X is 10 lakh. They got Z ka share 166. It will go on adding like this. Okay. Cash, all the assets one by one you add. Cash will get reduced by 1 lakh because they paid a PC of 1 lakh. Do not forget this. This generally we forget. And cash of Z we have not taken over. So don't add that. Okay. Bargain purchase gain will come in other equity. Capital reserve. Capital reserve will come in your other equity as such. Fair enough. That is the funda. This is your simple addition one, I think. Okay. Whatever entry you pass, you just need to do plus minus and do the balance sheet. Existing balance sheet they only given. All the assets acquired and liability acquired, you add it to the respective assets and liability, including your capital reserve and 1 lakh cash paid as PC will get reduced. Balance sheet will match out. This 20,000 no, capital reserve. Yes, what does the standard say? Whenever you get a bargain purchase gain, no, you rework your fair value. We have already covered this, right? In the Ind AS 103 itself recognizes that getting a bargain purchase gain is a very rare circumstance. Whenever you get it, the fair value of identifiable assets, once again you rework. Okay. Once again you reworked and if you got the same answer, all right, then check if you are able to prove that it is actually a bargain purchase gain due to valid reason. Then, like here, why did you get a bargain purchase gain over here? Because Z ka financial performance they told was bad over here, if you remember. Yes, Z had some financial stress. Financial performance of Z had not been improved. Yes, so he was facing some financial distress. Due to that, he sold this business at a lower stake. That means reason for you getting this bargain purchase gain is clearly known. It's a distress sell. Okay, so that is the reason. If the reason is known, then this bargain purchase gain, first you can show it in OCI. Okay, also you can show it in other equity. If you can justify that this is actually a bargain purchase gain with reason, then you can show it in your other comprehensive income and you can show it in other equity as capital reserve. If you are not able to justify the reason, why did you get this bargain purchase gain? then it will not come in OCI directly, it should be recognized in other equity as capital reserve. That's all is the funda. This is justification they've given for that, which we have done in our business Ind AS 103 business combination question also. Okay, that's all is this particular question, sir. Rest everything is just this working note, goodwill ka working note, DTL ka working note, and all they've put it. Okay, they put so many things and made it look big, but actually it is quite a simple thing. So just the main crux is check whether the joint operation is a business. If it is, then if one venture, if he has purchased stake from the other co-venturer, then the stake purchase will be treated as a business acquisition, and accordingly Ind AS 103 ka funda you need to apply. Meaning all the assets you showed at fair value, goodwill or bargain purchase gain you need to record. Due to this fair value changes, you may get some DTA DTL impact also. So recognize that. That's all as the funda. Okay. And if there is any acquisition cost that came because of this, transfer it off to P&L. That's the crux of this particular question. Okay. Hope this concept is clear for you. Thank you.